In any industry, there are terms that are difficult to understand. Today, I'm going to take 11 of the most complex real estate terms and simplify them for you so you can understand them better. If you are in the real estate field, you will most definitely come across most of these terms, if not all of them, especially if you are an investor. The first 8 terms are going to be focused mostly on residential and all types of real estate, and the last 3 will be mostly used in commercial real estate. The first term is cash flow. You hear this all the time in residential real estate or commercial or even in business. This is basically your gross income minus your expenses, aka profit. So an example would be if the business or the property brought in $4,000 a month in gross income and your total expenses for that month were $2,000, your cash flow or profit would be $2,000 that month. This could be during a month period, a quarter period, a year period. It doesn't matter, but typically when they talk about cash flow, they're talking about a monthly basis. The next term is cash on cash, or COC. You'll see this used interchangeably with return on investment, but basically it is your annual cash flow divided by your initial cash investment times 100. So what you put into the property is your initial cash investment, and then what it produces for you on an annual basis goes on the top. So let's say, for example, we had a rental property, and in the first year, $2,400 came in. We invested $50,000 into the property. So you take the 2,400 divided by 50,000, that gives you 0.048. Multiply it by 100, and that gives you a 4.8% cash on cash return. So that means that your initial money there that you made, 2,400, your return is about 4.8%. And you can compare that to getting other returns in, let's say, the S&P 500 stock market or another property, and see where your money is going to be working the hardest. Next term is return on investment. A lot of people use this, like I said, interchangeably with cash on cash, but they're really different things, because the return on investment takes into account not only the annual cash flow, but the appreciation of the property and the debt pay down. So it's everything all together, factoring that into what you put into the property. So you take all those things divided by the initial investment. So just like in that last example, our annual cash flow is $2,400. The appreciation rate on a typical property, let's say average, is 5%. So you're going to take 5% of whatever the property's value is. In this case, let's say it's $15,000 worth. And then the debt pay down, which is going to change depending on what loan you get. But let's say it's typically around 5% as well. So 5% of the loan amount, which is going to be about $12,000 in this example. We add that up, $29,400 divided by our initial investment of $50,000. It's going to give you a decimal of 0.58, and to change it into percent, we multiply by 100. So our ROI, return on investment, is 58%. That's significantly higher than just factoring in the cash flow on the property. This takes into account everything, and this is one of the most important return metrics used in real estate. This one you see all the time, and it's equity, right? This is the property value minus the loan amount. So if, for example, if we had a house worth $400,000 and the loan on it was $300,000, our equity position would be $100,000. So this is our capital in the property, right? That's what we own. That's our equity position. What you own minus what you owe. All right, return on equity. This is a useful formula when deciding whether or not you should hold on to a property or sell it, if it's a good time to sell or not. So the formula here is the net annual cash flow divided by the equity in the property. So for the example, if we had $2,500 in annual cash flow and we had an equity position of our last example of $100,000, it would give us 0.025 times 100, 2.5%. Now, what does that mean? It means that the money we have tied up in the property, the equity position that we have there, this $100,000 of equity is producing for us 2.5% return. So this is actually very low. So this would say, if I saw this and I had this metric in my property, I'd say, well, it's probably time to get ready to sell it because I can take this $100,000 in equity, sell the property, and put that money into a different asset that's going to produce for me more than 2.5%, because that's not too good of a return. So if I had more like 10 or 11%, then maybe that's not too bad, and I would consider holding on to the property a little longer. All right, loan to value, we have LTV. The formula is loan amount divided by property value. So for instance, if we had a $300,000 mortgage divided by the property value of $400,000, that gives us 0.75 or 75%. In other words, if we put a 25% down payment on a property, our loan to value would be 75%. And this is usually the minimum required by lenders for you to refinance a property. So it's important to understand these terms when talking to a loan officer. Debt to income, DTI, you usually hear this as a DTI ratio. When talking to loan officers, this is important to understand so that you can know if you are going to get approved for a mortgage or not. You're going to take your monthly recurring debts. This could be your current mortgage payment, car payments, student loan payments. These are fixed payments that are recurring every single month. And then you're going to take your gross monthly income. So that means, before taxes are taken out. So you have, let's say, $2,500 in monthly debt obligations divided by a gross monthly income of $5,000. This gives you 0.50 or 50%. 50% DTI means that half of your income goes towards paying off your debts. Now, this is high considering all things. When a lender sees 50%, they are most likely going to try to find a way to reduce your debts or increase your income in order to get approved for the loan. This is usually the maximum amount that a lender will look. They prefer 48% or lower typically, but it's going to depend on the risk tolerance of the lender. Amortization, you'll hear a lot when talking about mortgages. This basically just means the debt pay down of the loan, right? The schedule, you'll see a lot of the times when closing an amortization schedule. This is going to show you year one, this is how much your mortgage is going to be paid down by, and then it'll go year 2, year 3, all the way to the 30 year if you did a 30-year fixed, and how the debt will be paid down over time. Remember, in the beginning of a mortgage, you pay mostly interest, so the amount that your mortgage gets reduced in the first couple of years is smaller than in the last couple of years. So in year 1, let's say your mortgage is paid down to $240. In year 5, you'll be at $220, and by year 10, hypothetically, you'll be down to $190. So this is all that means. This big word is debt pay down. Now we get into commercial terms that you'll see most of the time in any retail, office, or big commercial building. Net operating income, or NOI, is very important, and you'll see that in the next couple of terms as well, and how that factors into everything. But it's basically your gross operating income minus your operating expenses. So this does not include your mortgage payment. This is just the total yearly income the property brings in, subtracted by what it costs to operate that property. So let's say it brings in $100,000 that year, and it costs $25,000 to operate it. Our total net operating income is $75,000. That's how much we bring in. And this is going to be factored into the upcoming formula that you'll see here through cap rate. Cap rate or capitalization rate, this is one of the most misunderstood commercial terms. It's basically your net operating income divided by your property value. So if your property is bringing in $75,000, you divide it by the value of $800,000, that's going to give you 0.09 or 9%. Now, a 9% cap rate, is that good or bad, and what does it mean? It could mean several things, and in this case, let's say we paid $800,000 in cash for the property. It's going to give us a 9% return every year based on what it's spitting out in income. That's one way to look at it. Another way is a risk metric. If it's a lower number like 4 or 3, that typically means that it's a safer, more stable investment in a good area, and it's a good building. If it's a higher number like 13, 14%, it's a riskier investment, and it's going to produce for you less cash flow, and it's going to require a little bit more of a risk tolerance. You can also determine these cap rates with your local real estate agent. It's going to vary on market to market on what these rates are. These can be given to you, or you can determine them. You can rearrange the formula to figure out pretty much any one of these three variables: cap rate, NOI, or property value. If you're trying to figure out the cap rate, here's your formula. But for instance, if you don't know the value of the building and you're just trying to figure that part out, but you do have the cap rate from your agent and you do have the NOI, this would be the way to determine what that building is worth. You take your NOI and you take your cap rate. So let's say for every dollar of net operating income, where the cap rate is 0.09, that gives us $11.11 of a property value. Now you'll notice if the cap rate goes down, let's go to a different market. For that same dollar that you get out of that property, that cap rate now is 0.04 or 4%. That's giving you $25 of a value. So that building is worth more because you're in a lower cap rate market. And then let's say our NOI is increased. We were able to increase the operating income to $2 in that same market, in that same building with a 4 cap. That's now going to give us a property value of double, or $50. So if you double the income on the property, you double the value. And this is one of those things in commercial real estate that's really awesome. You can't do in residential. If you drive up the income, you drive up the value. And you can't do this on a single family home. If you drive up the rental income, that doesn't immediately drive up the house value. It's dictated on what the other houses are selling for, but not so much in commercial real estate. All right, last term you're gonna see frequently in commercial real estate is debt service coverage ratio, or DSCR. The formula is your net operating income divided by your total debt service. The example here is if we made $125,000 in income in that year, and in order to service the debt on that property, including the mortgage and all other expenses, it cost us $100,000 in that year. So our DSCR is 1.25. So what that means is that we're producing more income than we are debt. So that's a good thing. Most lenders want to see a minimum of 1.2 to give you the loan on the property. So this is pretty bare bones, but like if you were producing more money here with the same debt, this would be a higher number, and that would be better in the eyes of the lender. If your DSCR is lower than 1.2, it's going to vary. The lenders have different minimums. But let's say for this example, it's lower than 1.2, you may not get approved for that commercial loan to buy that building. Or if you're in a refinance situation, same thing. You need to make sure the DSCR exceeds the lender's minimum. So there you have 11 of the most common real estate terms used. You can go out, talk confidently to loan officers and other investors. If you have any questions about any of these terms, leave it in the comments. I'll be happy to elaborate. Or if you want me to make a video on one or two of these so I can expand a little bit more, please leave a comment and let me know. Otherwise, have a great week. Remember, keep going, keep learning, and keep grinding.